Hey, good afternoon and good evening, everybody. We are getting together to go over Costco earnings. I am joined by my colleague. How you doing, Gerald?
Doing wonderful, Victor. How are you?
I'm doing well. I was looking forward to Costco because this is such a well-run company. I always respect and admire how professional, to the point, clear their announcements are, and I'll point those things out when I go through my fundamental analysis. And also, what we're going to do on this stream is really focus on Costco. I'm going to look at their earnings release, kind of go through some fundamental review, and then I'm going to analyze their fundamentals. I'm going to turn things over to Daryl. He's going to go over the charts, and we're going to look at the valuation of Costco. I've updated it based on the announcement of their fourth quarter for their fiscal year. And then we're going to tune into the investor call they're having in roughly 15 minutes. Listen in to what management has to say, and then we can discuss it. You guys on the chat can point things out that you're hearing, seeing. Please put in the chat your comments on Costco, what you think of the earnings, if you think they're good or bad, any concerns you see out there. Looks like we're getting a good flow of attendees. Thanks for joining, everybody. Good to see you, Saeed. So let me get started here. So Costco announced their earnings, and these guys are headquartered up in the state of Washington. They had net sales increased by 8%, which is quite a number considering they're very big. Their revenue in the quarter was $84.4 billion. So that's a lot of slices of pizza and hot dogs, and lots of food and all the consumer packaged goods that they sell. It's a store that sells in bulk. When we look at their overall sales, looks like their e-commerce number is growing nicely. And I have used their website, by the way. My wife and I like their website. They offer really good deals on it. And we've also gotten our auto insurance there. So they're trying to broaden, how they're trying to get deeper into my wallet. I don't know about you, Daryl.
Yeah, they're always into my wallet.
They've been in my wallet for like 25 years.
Yep,
And I
same for
have no
me.
problem, but Amazon's in there too. I think my wallet, somehow all these retailers have like 200% of my wallet, which
Yep,
is a
yep,
problem.
exactly. Yep.
So they grew nicely. 8% growth, I think, is very good. And they have a global business now. Looking at their income statement, and one thing I'll address is these guys keep their earnings really succinct, brief, not a lot of selling of how cool they are and the great things they're doing, and how they listen to their customers. They're just down to the numbers. The numbers are the most important thing to me. So I appreciate that, Costco. And here's their income statement. Income statement tells us, how did they do this year? Are they growing their revenue? Are more customers buying from Costco? Are they buying more things? So all that is positive. 8% growth on that top line is very, very good. When we look at their overall profitability, it also went up. So it climbed a little faster than the top line growth. That's also very good, meaning the business is operated effectively and they're making more profit. The share count stayed about the same. It increased a tiny bit, and I'd consider that fine because they're probably issuing out stock to employees that are important, issuing out some shares. Those shares are important to those employees. I think having employees that own the business is good for the business. That way they put their heart and soul into the company. They work those long hours and so forth. So I consider it, their share count is flat. So that's the income statement. The income statement tells us, how did they do this year? Balance sheet is, over the last 5-10 years, how have you been tending to the value of the business? The cash balance went up. It went up quite a bit. So it went from 10 billion up to 14 billion, and short-term investments stayed about the same. So that's good. because they're producing free cash flow, which is the next statement we're going to look at. Debt level. So debt stayed about the same. It went down about $80 million. Their debt is $5.7 billion. And they have a very good balance sheet. They don't have a lot of debt. You saw their top line revenues gigantic. So having that debt level is no big deal. Moving on to the statement of cash flows. See how quickly we're in numbers and just getting to what I believe is the most important part, which is numbers. And their cash from operations for the last year, 13.3 billion. And last year it was 11.3. That's a $2 billion jump from last year to this year. That's like an 18% jump. That's very good. It caused me to grow the growth rate that I have on their overall free cash flow model. I'll show that to you later. Their CapEx, now they're not buying GPUs like Google and Amazon and everybody else. They're just, doing the old fashioned capital, which is, we have a store, we had reconditioned that store, we had to buy equipment and so forth. It went up about 7, 8, I'm going to call it close to $800 million. And that is fine because their revenue grew. So as you're growing revenue, you got more foot traffic. Maybe you have one more store or a couple more stores and so forth. So the statement of cash flow looks really good. Excellent operation. As expected, these guys always they do what they're supposed to do.
Exactly.
Not flashy. They get it done and they report to investors. So why don't I let you cover the charts and then we'll come back to me. I'll cover my valuation after you're done.
Okay. So in the aftermarket, they did climb up a bit to about 948 per share. And for a spike there, these are 5-minute bars. For a spike there, they got up to 952. Then there was a fairly sizable drop, and now they're sitting about 935 and a half at the moment. The call will be here in about 8 minutes, so we'll see what statements the executives make on the call to determine it and continue watching these prices. I can tell you today, I actually trimmed 33% of my COSTCO holding. And my reason for doing that is we looked at this chart on Wednesday and we drew these trend lines on here, and we saw that it was coming down to a pinch point, which basically, I didn't know whether they were going to go up or down after the call, but they broke below that trend line today and closed below that trend line. So earlier this afternoon, maybe late morning, I actually closed out 33% of my holding just because I felt that the risk for me personally was a little bit too high. And I can always pick up the shares later. One other deciding factor for me, we'll look at Victor's valuation here pretty soon, but I look at fast graphs quite a bit to see how the company is trading with its fundamentals. And I haven't seen Costco this extended. Costco usually always has a premium.
Mm-hmm. I agree with that.
They're above their fair value. That's the gold line here.
Mm-hmm.
The blue line is the market multiple. So that's what the market is willing to pay for Costco. But since 2019, they haven't even been trading at that value. And today, in early January, February, they were trading at the most extended I have ever seen Costco to even the market multiple, nonetheless to their fair value. So that was another decision point that caused me to do a little bit of trimming today.
Very logical. Very good. So let me share my valuation, and I'm going to agree with the chart you just shared. My value of Costco. I think the Costco stock is priced 33% too high. When I go over the value of the company based on cash flow and then based on earnings per share, I get to $636 per share in value, and the stock is trading at $943. Something Daryl mentioned earlier that I totally agree with is Costco consistently trades at a premium. I agree. I don't think I've seen Costco trade at a discount in a long time. And maybe during the flash crash of COVID, everything was like, oh my God, the sky fell. It really did. And this one here, you know, if an investor has a cost basis that's really low and they just sit on Costco because you know what, it's Costco, can't argue with that. Cannot argue with it. I just don't. I don't own Costco. I wouldn't put any fresh capital into Costco. Um, I think the charts that Daryl was showing shows that the stock has plateaued. If you look at the return on the stock for the past year, it's 4.63 and a tiny dividend. So you're really pretty much at 5%. And we've been in a really good market. So this one here for a long time has just been like, set it and forget it. Just go ahead and buy this really reliable stock and it keeps going up. Amazing. And until it doesn't. And then you're like, okay, what now? So this one here is not an investment I would make. It's just, you know, it's a good company. I think the world of the company, but it's like, I made a video earlier about Rocket Lab. I love Rocket Lab. I'm a fan. I think it's great what they're doing, but I just don't like their fundamentals. I don't like their valuation, and I invest with my brain, not my heart. Costco, I think they have a very good business, and if I invest with my brain, I'm going to keep out of Costco. So that's go ahead.
I can show you my trades real quick if you want to
Yeah,
see those, just to see where I stand on
go for it.
Costco. So back in February and May, I sold 7 shares at 1,030, 1,035, and 1,012. And that was a 21% gain, a 17% gain, and a 9% gain. When it dropped down to 897 and 970 and 981, I bought 5 of those shares back. I closed this row, and this row out today. 2 for a loss, 1 for a gain that covers this loss. So my cost per share for the shares that I hold are now $6.68. But with my trades and dividends and what have you, my net cost per share is $4.87. So I made 15 trades with this for a win rate of 80% and a gain to loss ratio of 8.98 to 1. So
Nicely done.
That's my experience with Costco.
Nicely done. And I think Scott's due diligence, that YouTuber, he owns Costco and he got into it a long time ago, I think, based on memory. So for a long time, it's been like, man, that was a good move on his part.
Yeah, I bought it on a breakout.
Yeah.
3 years or so ago, and it's worked out very well.
Very good. So their call is going to begin in about a minute. So we'll just
Okay.
keep talking until it gets started and then we'll go from there. I don't know if there's any comments in the chat that you guys want to express on Costco, but feel free to, and we can talk about that. Costco, the one thing I would say, like, what are the threats to Costco is the world really did move online. Like Costco, the concept, was it born in like the 80s and then it kind of grew really fast in the 90s. It just seemed like the big box concept really, really exploded in the 90s and it's pretty much stuck. Well, that was before the internet. And now, like, you know, Amazon's gotten so good. It's just ridiculous. You can find any product literally that is available in any store on Amazon and they can deliver it very quickly. And that type of, I think, dominance is going to it's going to eat away at Costco's market share, Walmart's market share, as well as other retailers, even boutique retailers that, they, for a long time, their uniqueness was, hey, let's sell a product catalog that's unique to a category, right? Like, let's say outdoors people like REI. Totally get it. REI is a pretty cool store. Well, you can find all that stuff on Amazon now. And it's pretty darn convenient. You can do it from your phone, your computer, your tablet. So I think that's one of the I think causal factors for Costco is, hey, the world's online and your whole model is based on me going to the store. And I know I can go online and go to their website. I get that. But their classic model is go into the store, show your membership card, shop around, probably pick up some things you didn't plan on buying because it's such a good deal. Then you check out. They don't even have bags. They give you your stuff and you put it in boxes. You put it in your car. So I think that'll always be a long-term kind of risk to the company is that, you'll have the online category eating away at their market share. So
in the fourth quarter, we opened
we
10 new warehouses, including a relocation in Canada, our 20th warehouse in Korea, our second warehouse in Sweden, and 5 net new locations in the U.S. For the fiscal year, we opened 27 new warehouses, including 3 relocations for a total of 24 net new buildings. This brings our total warehouse count to 914 worldwide. We plan to open another 35 warehouses in fiscal year 26, of which 5 are relocations. We continue to see significant opportunities for expansion both domestically and internationally across the markets where we currently operate. Jerry will go into details about the quarter results, but a few highlights for the fiscal year. Net sales came in just under $270 billion, an increase of over 8% versus last year, and e-commerce sales exceeded $19.6 billion, increasing over 15%. And we had a record year for gas volumes, which benefited from longer gas station hours, new gas stations, and expansions of existing gas stations as well. We also recently celebrated a few milestones, including the 40th anniversary of our $1.50 hot dog and soda combo. Fittingly, we've just completed the rollout of Coca-Cola, the original soda partner from the 1985 inception of the iconic combo, to all food courts worldwide. Our private label Kirkland Signature reached its 30th year anniversary this year. Kirkland Signature sales penetration continues to increase, bringing even more high-quality value to our members while offsetting potentially inflationary impacts from tariffs. As mentioned last quarter, we are continuing to look at opportunities to move more KS product sourcing into the countries and regions where the items are sold, and this is helping to lower costs as well as reduce emissions from transporting goods around the world. To increase value and convenience for our members, on June 30th, we added executive member exclusive operating hours in the mornings, an additional hour on Saturday evenings for all members in our U.S. warehouses. We estimate these incremental hours have added about 1% to weekly U.S. sales since implementation. This has been very well received by our members. In addition to the early opening hours for executive members, we also introduced a $10 credit per month on Instacart purchases greater than $150. Since announcing these new executive benefits, we've seen the meaningful increase in upgrades from Gold Star members to executive membership. Another way we are improving the member experience is through the rollout of enhanced checkout technology in all U.S. warehouses. This is speeding up the checkout process by allowing our employees to scan small and medium-sized transactions while the member is still in line. So upon reaching the cashier, nothing has to be removed from the cart, only payment is needed. We also continue to make progress with our technology roadmap for digital and e-commerce. Enhancements this quarter included using data augmentation to improve search effectiveness, adding passwordless sign-in to our mobile app, and creating a waiting room for high-velocity items such as Pokemon cards. These waiting rooms reduce the traffic from bots, increase the opportunity for members to purchase high-demand items, while improving the speed and the stability of the site during peak traffic periods. Reflecting on fiscal year 2025 overall, our merchandising and operations team did a fantastic job delivering strong financial results while also investing in our employees and improving value and convenience for our members. Our merchants adjusted their plans to mitigate tariff impacts and source items that our members need while delivering the lowest price at the best value. Our operators quickly and efficiently adapted to pay raises in March of 24, July of 24, and again March of 25, that brought our average hourly U.S. wage to over $31 per hour, and most recently to the expansion of our operating hours. Their focus on efficiency and improving productivity allowed us to absorb these significant investments with minimal impact to our SG&A rate. As we look ahead to fiscal year 2026, despite the current macroeconomic uncertainty, we remain confident in our ability to grow market share by continuing to deliver exciting, high-quality items at the best value for our members. With that, I'll turn it back over to Gary to discuss the results for the quarter, and I'll jump back in during Q&A to field some questions.
Thanks, Ron. In today's press release, we reported operating results for the fourth quarter of fiscal year 25, the 16 weeks ended August 31st. As usual, we published a slide deck under events and presentations on our investor website with supplemental information to support today's press release. Net income for the fourth quarter came in at $2.61 billion, or $5.87 per diluted share, up 11% from $2.35 billion, or $5.29 per diluted share in the fourth quarter last year. Last year's results included a non-recurring tax benefit of $63 million, or 14 cents per diluted share. Excluding this tax item, net income and earnings per diluted share both grew 14%. Net sales for the fourth quarter were $84.43 billion, an increase of 8% from $78.18 billion in the fourth quarter last year. Comparable sales were 5.7%, or 6.4% adjusted for gas deflation and FX. E-commerce comparable sales were 13.6%, or 13.5% adjusted for FX. Our segment breakout of comparable sales is disclosed in both our earnings release and the supplemental slide deck. In terms of Q4 comp sales metrics, FX positively impacted sales by approximately 0.2%, while gas price deflation negatively impacted sales by approximately 0.9%. Traffic or shopping frequency increased 3.7% worldwide. Our average transaction or ticket was up 1.9% worldwide. This includes the impacts from gas deflation and FX. Adjusted for those items, ticket would have been up 2.6% worldwide. Moving down the income statement to membership fee income. We reported membership fee income of $1.72 billion, an increase of $212 million or 14% year over year. Adjusting for FX, the increase was 13.6%. Last September's US and Canada membership fee increase accounted for a little less than half of the membership fee income growth in the quarter. Excluding the membership fee increase and FX, membership income grew 7% year over year. This was driven by continued growth in our membership base and increased upgrades from Gold Star to executive membership. At Q4 end, we had 38.7 million paid executive memberships, up 9.3% versus last year. Executive members represented 47.7% of paid members and 74.2% of worldwide sales. As Ron mentioned earlier, we have recently seen a lift in upgrades in the US after we announced our executive member exclusive hours and other benefits. New member signups continue to be strong, and we ended the fiscal year with 81 million total paid members, up 6.3% versus last year, and 145.2 million cardholders, up 6.1% year over year. In terms of renewal rates at Q4 end, our US and Canada renewal rate was 92.3%, and the worldwide rate came in at 89.8%. The decline in renewal rates was largely attributable to a higher number of online signups entering the renewal rate, and this quarter included a large Groupon campaign in December 2023 entering the calculation. Overall, we view the growth in online signups as a net positive, as they are helping to grow our overall membership base and membership revenue, and are also introducing younger members to Costco. Almost half of our new member signups are now under the age of 40. As we previously shared, new online members renew at a slightly lower rate on average, and they have grown as a percentage of our signups over recent years. We would therefore expect to continue to see a small decline in our renewal rate as this change in membership mix gets fully reflected in our renewal rate calculation. That being said, through a focus on auto renewal and targeted digital communications, our goal is to improve the renewal rate for this cohort of new members in the future. Turning to gross margin, our reported rate in the fourth quarter was higher year over year by 13 basis points, coming in at 11.13% compared to 11% last year. Gross margin was up 3 basis points excluding gas deflation. Core was higher by 30 basis points and higher by 22 basis points without gas deflation. In terms of core margins on their own sales, our core on core margins were higher by 29 basis points. This increase was broad-based, with fresh, foods and sundries, and non-foods all up year over year. Supply chain improvements and an increase in KS penetration benefited margins in all categories, while fresh further benefited from lower spoilage and labor efficiencies. Ancillary and other businesses' gross margin was lower by 11 basis points and 13 basis points without gas deflation. Gas was the main driver of the decrease. LIFO negatively impacted the gross margin rate by 6 basis points. We had a $43 million LIFO charge in Q4 this year compared to an $8 million credit in Q4 last year. This charge was essentially in line with the estimate we provided last quarter, as overall inflation remained consistent with Q3. Moving on to SG&A. Our reported SG&A rate in the fourth quarter was higher or worse year over year by 17 basis points, coming in at 9.21% compared to last year's 9.04%. SG&A was higher or worse by 9 basis points adjusted for gas deflation. The operations component of SG&A was higher or worse by 15 basis points and 8 basis points without gas deflation. This increase was partly due to our investment in employee wages. As noted last quarter, the incremental year-over-year impact from this year's March employee agreement was mid-single-digit basis points, and the off-cycle wage increase in July 2024, which affected the year-over-year rate comparison for the first 10 weeks of Q4, was mid to high single-digit basis points. An increase in general liability charges and reserves also negatively impacted SG&A this quarter by approximately 5 basis points. To partially offset these headwinds, our operators continue to do a great job leveraging strong top-line sales and improving labor productivity. Notably, following the change in warehouse hours on June the 30th, our operators were able to minimize any impact to the SG&A rate. Below the operating income line, interest expense was $46 million versus $49 million last year, and interest income was $169 million versus $138 million last year. FX and other was a $46 million gain in Q4 this year versus an $18 million loss last year. In terms of income taxes, our Q4 tax rate was 25.6% compared to 24.4% last year. As a reminder, last year's tax rate included a non-recurring benefit of $63 million related to a transfer pricing settlement and true-ups of tax reserves. Turning now to some key items of note in the quarter. Capital expenditure in Q4 was approximately $1.97 billion, and for the full year was a little under $5.5 billion. We made some additional investments in Q4 to support accelerated warehouse growth, including the 35 planned openings in fiscal year 2026 that Ron mentioned earlier. Additionally, we increased our pace of spend on remodels to ensure that we continue to offer our members a best-in-class experience across all of our warehouses. Land purchases for future depot expansions and investments in our manufacturing facilities for expanded hot dog production and a new coffee roasting facility also contributed to the increased spend. A few fun sales facts as we wrap up our fiscal year. While our members love the treasure hunt items that they find in our warehouses and online, our everyday value items are also extremely important to them, especially in times of economic uncertainty. There are no better examples of this than our hot dog combo, rotisserie chicken, and KS bath tissue. And in fiscal year 2025, we sold over 245 million hot dog combos, over 157 million rotisserie chickens, and enough bath tissue to reach the moon and back over 200 times. Now taking a look at core merchandising sales in the quarter. Fresh sales were up high single digits, led by double-digit growth in meat. We continue to see strong unit growth across the department due to the quality and value we offer on both premium and lower cost proteins. Wagyu and grass-fed beef performed well in the quarter, and lower cost proteins like poultry, pork, and ground beef also saw very strong unit growth. Non-foods had comp sales in the high single digits. Our buyers continue to do an excellent job finding new and exciting items at great values, which are resonating well with members, even as they remain very choiceful in their spending on discretionary items. In the quarter, gold and jewelry, gift cards, majors, toys, and men's apparel were all up double digits. While gold was less of a year-over-year tailwind than earlier in the year, as we have now started to lap sales from a year ago, it continues to perform well. Strength in gift cards was driven by Disney, Uber, and DoorDash, and majors were up high teens, with consumer electronics leading the way. We also added a number of new high-quality national brand partnerships across a broad range of non-food categories, including Fabletics, True Classic, Aura, and Lazy Boy. Food and sundries had mid to high single-digit comps, with cola and candy showing the strongest results. New Kirkland Signature offerings allow us to continue to deliver greater value to members and are high-quality alternatives to some tariff-impacted goods. KS items typically offer members 15 to 20% value compared to the national brand alternative with equal or better quality. In Q4, we launched over 30 new KS items, including grass-fed beef sticks, organic extra firm tofu, and various apparel items, in addition to our latest food court offering, the Combo Calzone. Within ancillary businesses, pharmacy, optical, and hearing aids all had strong quarters. And while gas volumes were positive low single digits in the quarter, gas comps were negative mid to high single digits due to a lower average price per gallon. Turning to inflation. Overall, inflation remained in the low to mid single digit range. Fresh and food and sundries were relatively similar to last quarter, with higher inflation in key commodities like beef, coffee, sugar, and corn, partially offset by lower inflation in produce, eggs, butter, and cocoa. In non-foods, we saw inflation return for the second consecutive quarter, primarily driven by imported items. This inflation drove the $43 million LIFO charge for the quarter, which is calculated by comparing the net landed cost of inventory at the beginning of the fiscal year with the net landed cost of inventory on hand at the end of the fiscal year. We continue to work closely with our suppliers to find ways to mitigate the impact of tariffs, including moving the country of production where it makes sense and consolidating our buying efforts globally to lower the cost of goods across all our markets. Additionally, we are changing item assortment where appropriate. This includes leaning into KS items and increasing domestically sourced goods. Examples include an increased emphasis on items in health and beauty, live goods, tires, and mattresses. We believe our expertise in buying and the flexibility afforded by our limited SKU count give us greater agility to navigate the current environment and minimize the impact of tariffs. Our ultimate goal is to increase our member values compared to the market. From a supply chain perspective, we haven't seen any major changes since last quarter. Overall, supply remains relatively stable with no notable issues. Looking ahead to the holiday season, our merchants feel good about our inventory position. And while the product mix will look a little different from years past, we will have a strong assortment of high quality items that bring meaningful value, seasonal themes, and exciting newness to our members. Turning now to digital. E-commerce site traffic was up 27%, and sales were led by gold and jewelry, housewares, apparel, tires, sporting goods, majors, small electrics, lawn and garden, and domestics, all of which grew double digits year over year. We continue to grow share in big and bulky items sold online, powered by our investments in COSTCO logistics. The combination of great values and the delivery experience that includes installation and haul away of old items is resonating extremely well with members and resulted in a 13% increase in items delivered in the quarter. Q4 fiscal year 25 marked the 15th consecutive quarter of improved member experience scores on COSTCO logistics deliveries. A key focus of our digital strategy is to deliver a seamless experience and more personalized and relevant communications to our members. This is a multi-year journey, and as we complete the foundation elements of our plan, we are able to launch new experiences for members. For example, during the fourth quarter, we launched more relevant messaging on the Costco.com homepage, highlighting different offers depending on an individual's membership type and co-brand credit card status. Executive members are shown information about executive benefits, while Gold Star members are encouraged to upgrade their membership, and non-members are shown information about becoming members. Co-brand card holders will be shown offers associated with ongoing spend campaigns, while non-card holders will be shown acquisition offers. These digital capabilities are also a key enabler for retail media, as they allow us to target specific ads that deliver greater value for both members and suppliers, while always honoring the privacy choices of our members. As an example, we recently executed a series of targeted MVM amplification campaigns with Kimberly-Clark on third-party websites. This resulted in a strong return on ad spend of 14-1, drove a 22% increase in traffic to the product details pages, and a 45% increase in digital sales of the promoted items. As we continue to execute our digital and technology roadmap, we are excited about the opportunities this creates to further enhance the member experience and drive top-line sales. Finally, in terms of upcoming releases, we will announce our September sales results for the 5 weeks ending Sunday, October the 5th, on Wednesday, October the 8th, after market close. Based on feedback received from investors, starting with our September sales release, we'll be changing our e-commerce comparable sales metric to now report digitally enabled comparable sales. This measure will incorporate all sales that originated online, including our same-day delivery service fulfilled by Instacart, Uber Eats, and DoorDash, Costco Travel, Business Center Delivery, and a few other smaller direct-to-member businesses. We believe this change aligns our reporting more closely with how our retail peers disclose this metric. For fiscal year 2025, our digitally enabled sales totaled more than $27 billion. That concludes our prepared remarks, and we'll now open the line for questions.
Thank you. And if you have dialed in and would like to ask.
All right. So coming back, so it was a good quarter. There's just not, a ton of excitement in the stock. And for the past year, if I compare Costco to Walmart, Walmart has really done a lot better for the last year. If we look at the last 5 years, Costco has done better than Walmart. So something for the past 12 months, I mean, I guess the smart buy was Walmart 12 months ago when they were trading at their prices previously. And any thoughts on what you're hearing and your thoughts on the stock at this point, now that we've looked at their earnings, listened to their management talk?
I was interested to hear about the executive membership and the adjusted hours. My wife actually loves that because the store is a lot less crowded. and they're actually enforcing that at our local store. So they're actually, making sure that you're an executive member to get that in there an hour earlier.
Mm-hmm.
So my wife really likes that, and then I was kind of glad to see how much it had impacted their revenue numbers. I can't remember all the specifics, but they did say it had a positive impact. So I thought that was rather interesting. The way they're adapting to tariffs is also, all the retailers are having to do that. So it'll be interesting to watch,
Mm-hmm.
over the next couple of quarters to see how they're adjusting, what the impacts to their business is.
Mm-hmm. And what's interesting is I added Costco to this compare. I'm sorry, Amazon. I added Amazon to the comparison of Costco, Walmart, Amazon. And over the 5 year, you're not doing all that hot on Amazon. Walmart's doing well. Costco's doing great. Now, if you were to say which company has created a, a more valuable future over the past 5 years, Amazon. Their their business they became the number one revenue company in the US at 600 and some odd billion. They took it over from Walmart. Their cloud business is number one in the world, really profitable. They have robo taxi business. Their streaming business is doing great. Their ad business is doing great. So it's interesting to see that, hey, do I consider Costco kind of do they own a big part of the future? Are they strategic? Like, do they have technologies that are going to be game changers, big moats in the future? No, they're a good retailer. They have a membership program. Walmart, kind of the same. They're big. I'll give them that. And Amazon, I think, is just strategically more desirable, but the returns are very different. Isn't that interesting?
Yeah, throw Target on there.
Oh, Target's kind of a basket case, right?
Yeah, I know. But people that keep asking about it,
Now, do I
whether
pronounce it Target or Target?
it is definitely Target nowadays.
Yeah, Target is not good. Over the last year, I think it's really bad. 43%. Oof, not good. Yeah, and I don't know that Target's gonna make any comeback. Being a retailer is so hard. I think that although it's kind of a pain in the neck, how Costco, when you walk out of the store, they check your ticket, they check your basket. Well, maybe Target needs to start doing that, and so does Walmart, because the theft at retail has gotten really out of hand. And I know that Target's probably dealing with that. So that might be, the wave of or what retailers have to do to keep people from stealing stuff, and maybe more security and so forth.
Yeah, my last trip to Target was probably 7 years ago, and we were on a trip, and I had to. I think I forgot some toothpaste or something. I had to get some toothpaste and one other thing. I had to go
Mm-hmm.
find somebody to unlock every single. I think I bought 5 things. I ended up with 3 because I got tired of having to ask somebody, and then they'd walk off. You know, and that was my absolutely last time I ever walked into a Target.
The one thing I go to Target for is, right. I've got nieces and nephews that have little kids now. Their toy section is, at least in Southern California where I live, they've got the best toy section, and toy stores don't exist anymore. So if I'm like, okay, you can go online, but you don't get to see the toy and kind of go, this is for a little girl, this is for a little boy, whatever. So I kind of find that experience useful at Target. Their apparel, we've never bought their apparel. And the other things, I could take or leave. Yeah. All right, so we got a couple questions coming up. So we're done on Costco. Any last thoughts before I turn our attention over to the TikTok
No, it
deal?
looks like they did what they are supposed to do. And their price is still sitting around 337. So let me just, what is that percentage? So that's
It's
about
down.
10. That's about 1%. And the implied move was 4%. So they're definitely not swinging as much as the options traders are pricing in, at least in the pre-market. We'll have to see how it trades tomorrow.
So the market's traded lower 3 days in a row.
Yep.
Now, Costco is a staple stock. So this is like it's time to shine, right? Is when tech stocks and growth stocks are having a hard time. Hey, Costco's usually a nice place to go seek shelter. Having said that, again, I showed my valuation. It's an expensive stock. Not the first time I've said that. I'm not like, where do I think Costco is going to be in 5 years? I think they're going to be fine, but there isn't going to be much expansion. There isn't going to be much growth. It's like they're not going to be that much more interesting and valuable, in my opinion. For all we know, in 10 years, 5 years, we're going to have robots. Every retailer is going to retail is going to be very different. It's like, hey, you just tell us what you want. We're going to have robots deliver it to you. And it's like, oh, okay. That sounds pretty convenient. And so we'll see. We'll see. I just think Costco is not going to be in my portfolio unless it were to really crater, which I don't think it's going to do. I'll just stick to my Amazon stock and I'll keep loading up on Amazon. Okay, so let me turn my attention. I heard there was a TikTok deal, and the company that's supposed to benefit from it is Oracle. So let's see what's going on. So Oracle's up a little bit. So TikTok, all right, all you TikTokers, don't worry. It's going to still be in the United States. He signed the executive order, and it'll continue to operate in the U.S. I don't think anything changes, right? The app was already, the data was already being held in the U.S., so that's fine. So that's the news. It's not really causing a big move in Oracle. Oracle's the stock has been down a little bit over the last 5 days, but it's had a terrific month. So that was a news item on the chat. Let's see if we got anything else that we should talk about based on the chat here. So we talked about TikTok. And so little J might have a question for you. Daryl, can you help me decide between XLF or V for swing trading? How does Q4 seasonally look for both?
Okay. I've got a seasonality chart pulled up.
All right, cool. Let's go to your screen.
So I'm looking at the past 13 years for XLF. In October, November, and December are some of the better months for seasonality. And so this is a broad financial sector. There are some ways to look down below what's in the XLF and find those that even have better performance than this overall. But let's look at V or Visa, and we'll also look at 13 years. They also do pretty well in the final quarter of the year. which if you look at banks, so if we look at the Dow Jones USBK sector or industry group, they actually do really well in the fourth quarter. So 3.2% in October, 7.2% in November, and 9.2% in December. So if you're looking for some outperformance, let me add the SPX here. If you're just looking for trades and you're looking for outperformance in the fourth quarter, you're going to get outperformance of 1.6, 3.3, and 0.2. And then if you look at the ETF KRE, which is the regional banks, we go out 13, still comparing to SPX. So this is relative, is 1.7, 3.4, and 0.2. And if I look at it in absolute terms, 3.3, 7.3, and 0.2. So if you're looking for some outperformance in the fourth quarter, regional banks, the ETF, you could even dig down in the KRE and see which ones perform the best in that ETF. You could look at the banks industry, look and see which banks are set in those. Those are going to be the bigger banks, I think. And then the XLF is going to be a bundle of a whole bunch of stuff like banks and regional banks and probably asset managers. So you're going to have less volatility. So if you're looking for real outperformance, I would dig down a little bit further using these paths that I'm sharing here. Hopefully that helps.
That was really interesting. So, looks like Meta is in talks with Google to use Gemini to improve ad targeting. Interesting.
Don't they have their own AI?
That's what I was thinking. It's like, I thought they had their own AI, but maybe it's not getting it done. So Google's up a little bit in after hours. That looks good. Google's had a good 30 days, hasn't had a couple good days. It's down from 255 down to 246. But the last 3 days have been a sell-off in the market. Not a drastic one, but a sell-off. So that's what's going on there. All right, perfect. Well, I think mission accomplished on the COSTCO earnings. Thanks, Daryl, for co-hosting. I appreciate it. And tomorrow morning, guys, we're going to be streaming again. We're going to have a normal morning stream. So if you have some stocks you want to look at, join tomorrow, 9 a.m. Eastern. And we'll go through the typical format, which is, looking at stocks and going fundamental analysis and then looking at the charts. So any last thoughts, Daryl?
Not from me. I appreciate you inviting me and having me co-host. And thank you, everyone, for your comments and listening to us. We appreciate that. Thank you.
Definitely. Everybody, thanks so much for tuning in. And we'll catch you on the next earnings call. We're going to hopefully get good at this. And then I'm sure it's going to get busier in about a month. And then we can probably hit the biggest earnings calls and talk about them, analyze them in depth. So everybody have a terrific night. Join us in the morning if you have time, and good luck with your investments. Take care.
Great.